In this video, I'm going to walk through calculating the margin of safety. We're given a company that's a distributor of a sun umbrella used at resort hotels. And their upcoming budget appears to tell us that the selling price per unit is going to be $30, variable expense per unit is $20, fixed expense in total for the month is $7,500, and we're anticipating for the month that we're going to sell 1,000 units. And they want us to calculate the margin of safety and also the margin of safety as a percentage in its dollar sales. I will note margin of safety can be calculated in dollars, it can be calculated in units, and also as a percentage that we have here. Even though they didn't come out and spell it out, they want us to calculate the margin of safety in dollars. So what is the formula then for margin of safety? It's our current or budgeted sales dollars, so where we are now in sales or where we hope to be, minus our break even in sales. And again, in this example, they're asking us to calculate that in dollars. Well, before I can start to solve this for this problem, we need to calculate our break even in sales. And I already had a previous video that went over that, so I'm just going to go through it quickly. That would be our fixed expenses in total, which is $7,500, divided by our contribution margin ratio. And recall that would be our contribution margin per unit, which is $30 selling price minus $20 variable cost, or $10, divided by our selling price of $30. I will note, if you go through the full problem, it says don't round your intermediate calculations. This is going to be 1/3, so you want to take it out as many decimal points as possible instead of 33%. Divide that into 7,500, and we get that our break-even point in dollar sales is 22,500, which is just saying that's how much in sales revenue for sun umbrellas we need to sell to get to a profit of 0 or to fully cover all our costs with our sales. Now jump back to margin of safety. We want to take our current or budgeted sales level. Well, they don't tell us that directly, but also recall we were given our budgeted unit sales per month of 1,000 times, we can take that times our selling price of $30. That would be sales of 30,000 minus our break-even point we just calculated of 22,500 gives us a margin of safety of 7,500. Again, we went through the calculation, but what does this mean? A margin of safety you can think of as a cushion. How far above or below? Here we're at the benefit that we're above. Our current sales level is 30,000. Our break even is 22,500. So our cushion is 7,500. We can lose up to $7,500 in sales before we hit our break even point and get to a profit of 0. Again, we can lose up to $7,500 in sales before we hit our profit of 0 and hit our break-even point and run the risk later of losing profitability. Margin of safety could be negative if our current sales level, say, was 20,000 versus 30,000. It would be negative. It would be how much sales we need to gain in order to hit that profit of 0. Margin of safety as a percentage is just going to take the margin of safety we just calculated. In this example, it's 7,500 divided by our current or budgeted sales level, which again, we already calculated as 30 times 1,000 or 30,000. It would calculate to be 0.25. Convert that to a percentage and would be 25%. So again, we can lose $7,500 in sales before we hit a profit of 0, or another way of looking at this is we can lose 25% of our sales again before we hit that profit of 0. Hopefully that's a helpful explanation of margin of safety.